Hello traders, welcome to lesson 2 of our free masterclass video series program. Now in today's video, we are going to continue in our discussion about market structure. We are titled this one Market Structure Part 2. Now, if you haven't watched the part 1 of our market structure, please check it out. I will leave the link in the description. Without understanding the basics of market structure, you won't be able to understand this part 2. So please do well to watch the part 1 first before you come to this one. Now, I did promise last week that in today's lecture or lesson, we are going to go deeper into the concept of market structure. Now, I'm going to show you three important things about market structure that you need to understand. Number one, you need to understand what a valid swing high or a swing low is. A valid swing high or a valid swing low. That is number one thing you need to understand about market structure. All right? Now, let me quickly show you that one. Take a look at these three candles here. Okay? Candle number 1, candle number 2, and candle number 3. I'm going to give you 2 rules by which you can identify your valid swing high in the market or valid swing low in the market. All right? Now, take a look. The rule 1 is that the high of the middle candle of this 3 candle formation must print the highest high. All right? And as you can see, take a look at the wick of this candle. This is the middle candle of these 3 candles. And as you can see, it has printed the highest high of the 3 candles. All right? That's rule 1 that you must observe. Rule 2 is that the candle to the right of the middle candle, all right, the candle to the right of the middle candle must close below the low of the middle candle in the case of a swing high, that is. All right? Are you clear with that? The rule 2 is that the candle to the right of the middle candle must close below the low of the middle candle. All right? In the case of a swing high. All right? These are the 2 rules. Now, the opposite is the same for swing lows. All right? The middle candle, let's quickly just see whether we can convert this one downward. All right? So that we can save time. All right? Let's see whether we can do something with this. All right? So the low of this middle candle, let's see first whether we can convert it very well. Okay, so now the case of a downtrend, all right, the case of a swing low is that the low of the middle candle, all right, as you can see, must print the lowest low. That is the first condition. Second condition is that the candle to the right of the middle candle, in the case of a swing low, must close above the high of the middle candle. All right? So that's about the swing high and the swing low. All right? So I want you to understand that one. Let me quickly show you that one on the chart so that it doesn't confuse you. Let me quickly show you what I mean on the chart before we go back to the whiteboard so that I can show you more things. All right? Let me quickly show you that one on the chart. Now take a look. Let me see a good example I will show to you. All right? Now, let me see. Okay, let's take this for instance. Take this for instance. Okay? Take a look at this candle. This candle here. This bearish candle. Look at the wick of this candle. All right? It has printed the lowest low. If you can't, this is candle number 1, candle number 2, and candle number 3. Isn't it? Now, the middle candle of this 3 candle formation, the middle candle has printed the lowest low in the case of a swing low. All right? Now, that's rule number one. Rule number two says that the candle to the right of the middle candle must close above. Now, there is another variation. Let me give you that variation. The variation is that if the number 4 candle or number 5 candle closes above the immediate preceding candle, it still makes this law to be valid law. All right? So, as you can see, the candle to the right of this middle candle did not close above the high of this middle candle. But candle number 4, all right, close above the high of the immediate preceding candle. All right, making this law a valid law, a valid swing law. All right, so that is the way for you to identify. That is the way to identify a valid swing high and a valid swing low. Let me show you one more example before we move forward. Before we go back to the whiteboard, let me show you one more example. All right, now take a look at this. All right, this is candle number 1. This bullish candle here, this small bullish candle is candle number 1, candle number 2, and candle number 3. All right, this is in the case of a swing high. Now, the first rule says the middle candle of this 3 candle formation must print the highest high. And as you can see, it has printed the highest high. Okay? Now, rule number 2 says the candle to the right of the middle candle must close below the low of that middle candle in the case of a swing high. And as you can see, it has closed below the low of this middle candle. All right? Now, validating this high as a very valid high. So that is how you determine your swing high or your swing low. All right? So let's get back to the whiteboard, and so that we can see what we are talking about here. Now, let me get back there. That is about the swing high and the swing low. All right? Now, the next concept we want to look at in terms of market structure is we want to look at major structures in the market and minor structures. All right? Now, a lot of traders are confused about major and minor structures. And in this lesson, I'm going to show it to you. I'm going to simplify everything to you. Now, the reason why many traders are confused about major and minor structure is that traders like to go to their lower time frame, directly to their lower time frame, like the M5, and begin to restructure from M5 and take trades from there. This is wrong. All right? Now, I'm not saying you cannot use any time frame as a higher time frame, like the 15 minutes can be your higher time frame, like the 1 hour can be your higher time frame, 4 hour, D1, weekly, and so on and so forth. All right? But it is better for you to know what your higher time frame is doing in terms of directional bias. All right? In terms of directional bias, then you can go to your lower time frame and begin to look for opportunities to get into the market. All right? Now, this is what happens. Take a look. This high, take a look at this high, these black lines that you are seeing. Let us assume that this black line is your H4. All right? Your H4 time frame, the black lines. Now, these red lines, let's assume it's your M15, your 15M time frame. All right? Now, take a look at how market moves. Okay? Now, this is your H4 time frame, the black lines. This is your swing high. All right? And this is your swing low. I'm talking about your H4 swing high and your swing low. All right? And when price is having that one leg on your H4, what should we find on, say, your 15M will be that price on your 15M will begin to make low, lower high, lower low, lower high, lower low, lower high, lower low, in line with this your higher time frame structure. All right? This is your swing high and this is your swing low. All right? Now, when price is retracing on your higher time frame, all right, the way for you to catch a move in the market, a big move in the market, all right, is for you to monitor what is going on your lower time frame, because your lower time frame will first have a shift, all right, a market shift on your lower time frame before your higher time frame will begin to move. All right. Now, as you can see here, this red line, this is your M15. I say, let's take this as M15. All right. Now, price printed a low here, lower high, and then lower low. All right. And then before you know it, just at this point, at this your H4 swing point, all right, major swing point, price goes up. All right. To take out this minor structure. Now, this black lines is known as major structure in the market. These red lines are the minor structure, your lower time frame structures in the market. All right. Now, on your M15, for instance, price change direction here, whereas your H4 is still bearish, but your M15, for instance, is now changing to bullish. Can you see that? So price has violated structure here on your M15 to the upside, indicating that any moment from now, your higher time frame, which is the H4, will also change direction and start going higher. That is by way of retracement. All right. This is known as retracement. All right. So I want you to understand that one. It is on this your lower time frame that you will get opportunities to get into the market early enough. All right. Once you find a change of direction here, price broke structure here. Let me show it to you. All right. Price breaking structure here. That should indicate to you. All right. There is a break of structure there. That should indicate to you that there will be an OB sitting somewhere here that you can take advantage of on your M15. There will be an OB there. All right. That price will come in to go higher. All right. On your M15. So you can take advantage of that. There is a shift in market direction on your M15 here. So capitalize on that shift and get your trade from here. All right. That is what you need to do. Okay. Now, as price now gets to this, when price on your H4 has retraced to this point, now on your M15, price is also making high, higher low, higher high, higher low, higher high, higher low, and higher high. All right. Now, price came down on your M15 to break structure here to the downside. Look at this break of structure. All right. Take a look at that break of structure there. Once it breaks structure on your lower time frame, all right, then you should know that price is now aligned with your higher time frame, okay, to go and break this structure here, the major swing law here. All right, you should expect that price is going to break that major swing law to go lower, okay, because price has shifted direction here. There is a shift in direction on your lower time frame. I want you to understand that very well, guys. I want you to understand that there is a shift here in market structure. I mean, in the direction of the market on your lower time frame, and therefore your higher time frame, before your higher time frame will change direction to go lower, your lower time frame would have changed direction. All right, but it's important for you to understand your higher time frame swing points. I cannot emphasize that enough. And therefore, you have it happening every time. Look at here again. Price came down to break this structure here. On your lower time frame, you are having low, lower high, lower low, lower high, lower low, lower high, lower low. All right? And after printing this lower low, now your H4 is still bearish. Now, but on your M15, price went up and violated this structure. Can you see that? It violated that structure to the upside, indicating that there is a shift. All right, there is a shift in structure. All right, but your higher time frame, the H4, is still bearish, whereas on your M15 it is bullish. That is showing to you that your H4 will begin to retrace from here. All right, and as you can see, as price was going up, your H4 also retraced and got to this point. And on your lower time frame, price is making higher high, higher low, higher high, higher low, higher high. And then price came down to violate this structure again to the downside. All right? Indicating that there is a shift in structure. Whereas your higher time frame is still bullish, but your lower time frame now is bearish, in line with the prevailing market condition, which is bearish. All right? So as soon as you find that confirmation that it has broken to the downside, now you look for an OB on your lower time frame, all right, to go short. All right? This is the way you trade the market, guys. It's as simple as that. Don't complicate things. Okay? Don't complicate things. What you monitor is the higher time frame swing points. Mark them out with horizontal lines. All right? And then go down and begin to monitor your lower time frame. When you find a shift on your lower time frame, then you can capitalize on it and get into the market. All right? That's the second concept I want to tell you about market structure. Then the third concept and the final concept I want to share with you today is that you will need your retracement. Your retracement when price is moving, for instance, this downtrend. All right? Now you know we have impulse, correction, impulse, correction, impulse. Now, this is impulse retracement. All right? To what extent should your retracement be for you to regard it as a valid retracement? All right? Now, I want to let you know that your retracement must get to at least the 50% FIP level. Your FIP level. Use your FIP level to measure at least the 50% FIP level. Let me show it to you. This is, all right, this is your swing high, your impulse, correction, impulse, isn't it? Now, let us take a look at this point here. All right? If you measure, if you mark your FIP from this point to this low here, this low, all right? Let's mark it to this low. I want you to understand it. Follow me, guys. All right? You mark it to this low. Now, you want this your retracement, this retracement leg, this black line that is retracing. You want this retracement leg or this red line to retrace into this premium zone. Of course, you know this is a premium zone and this is a discount zone. You sell from premium and you buy from discount. All right? As you can see, price entered into that premium zone. You want price to retrace to at least the 50% of your FIP tool for you to regard it as a valid retracement. All right? I see in the market that traders are marking every small move as a break of structure and as a retracement. This is wrong. So that is one way for you to know a valid retracement. There are two ways, but I'm going to tell you the second way as we progress in our masterclass program. All right? But for now, be sure or know that your retracement must retrace to at least the 50% FIP level before it can be regarded as a valid retracement for you to begin to look for opportunities to enter the market. Okay? So that's about that. Now, let me show you the reality of the market, guys. Now, take a look at this diagram. This is the reality of the market. If you see this kind of structure in the market, what do you do? What do you do? Where do you mark as your high, your swing high? And where do you mark as your swing low? All right? Given what I have discussed with you now. Where do you mark as your swing high and your swing low? Now, let me tell you guys, this is your swing high. Take a look at my cursor. This is your swing high. All right? Now, all these that you find here, they are just bigger consolidation. Market is just moving sideways. All right? So, let me use horizontal line to show it to you. This is your swing high. All right? And where is your swing low? This is your swing low, guys. This is your valid swing low. Take a look. This is your valid swing low. Oh, God. What's this? Oops. What did I do? Just a minute, guys. What's happening? Okay, so this is your swing high, this is your swing low. All right? This is your, What's happening? So that's your swing low. Okay? Your swing high, your swing low. All these that you see here, they are minor structures. Like I explained to you, these are minor structures. All right? This is your swing low. This is your swing high. Now, as you can see, price broke that swing low to the downside. Can you see? Now, if you take your fib tool and mark from here, take a look. If you take your fib tool from here and mark to this point, did it retrace to 50%? Yes. Price retraced to 50%. All right? As you can see, this price retraced to 50% here. Can you see that? So I want you to understand that very well. Now, price has violated structure again here to the downside. All right? Once you find that, like I taught you in the lesson 1, once you find that as price retrace to 50%, now let's see. If you take your fib tool, if you take your horizontal line, put it there. This is your high, this is your low. And where is the high that produced that low? Of course, this is the high that produced that low. All right? That's the high that produced the low. Okay? Now, let's see. This retracement, did it get to 50% fib level? Take a look at it. Did it get to 50% fib level? Sorry. That's a mistake. Let's see if it retraced to 50% fib level. All right? As you can see, it retraced even above the 50% fib level. Can you see that? So this is your valid low. Now, where is your valid high? This is your valid high, valid low. Now, price broke the structure to the downside. So you move your horizontal line again to this low. All right? To this low here. Okay? And where is the high that produced this low? It is this high here, like I told you, I taught you in the lesson 1. And as you can see, price has gone even above the 50% fib level. All right? So this is the way you follow structure in the market. All right? Number one thing, let me quickly refresh your mind, is that your swing high, your swing low, this is the way you determine it. This is your swing low and your swing high with these 2 rules I gave to you. And then understand something about this major structure point and major structure lows. All right? And then understand your minor structures. All right? Inside your major structures. You will take advantage of these minor structures to get a trade setup in the market. All right? Now, let me quickly get to the chart. Now, before we get to the chart, let me say this, that our next lesson is going to touch on external and internal range liquidity. So you need to stay tuned. All right? It's going to touch on external and internal range liquidity, and it is key if you must succeed in trading the forex market. All right? So let me quickly show you some of these things on the chart so that we don't take much time. Okay? Now I'm going to show you like 1 or 2 examples and then we call it a day. All right? Okay. So now take a look at this. Let's look at this point. As you can see, price is pretty much bearish. All right? We're bearish. Now take a look. Your horizontal line. Let's use the horizontal line to make it easier. This is your high, isn't it? This is your high in the market. All right? Now, take a look. All this is minor structure. All this is minor structure. This is your actual low. All right? This is your actual low in the market. And therefore, you bring your horizontal line to that low here. All right? That's your actual low in the market. Okay? That's your actual low in the market. All right? Now, if you use your fib tool to see, did it retrace to 50% fib level for you to say it's a valid retracement? Let's check. As you can see, price went back even above 50%. Now, let me say this before we go further. Even when price has retraced to 50% fib level, guys, let me be very honest with you. Let me reveal the secret to you. You still need price to get into at least the 61% fib level. All right? At least to go to the extreme of your premium zone before you sell. Because selling at this 50% sometimes can be very risky. But you can take the risk nevertheless. It is still okay. All right? But the way I trade is that I want to trade from the extreme of the premium or discount zones. All right? So that is about that. So price has retraced even above the 50% fib level. All right? And if you look, this is your valid swing low. All right. So now price has violated that structure again to the downside. All right. And has retraced. Okay. So is this your valid low? Yes, this is your valid low, because if you look, where is your high? Now remember, this is the high, this is the low. All right. And price has retraced to that 50% FIP level before dropping again. Now, where is your new high? Your new high is here. All right. Your new high is here. Okay. And where is your new low? Your new low is now here, like I taught you in lesson 1. Now, let's use our FIP tool and see whether it retraced to 50% FIP level or not. All right. From this high to this low. All right. Can you see that? It retraced to even more than the 50% FIP level. Look at this retracement. Went to more than that 50% FIP level, which is a valid retracement. And that is why you can find an OB sitting somewhere there. All right. All these places I'm marking, we are not treating the issue of OB just yet, but I'm just showing you that this is your OB here, because it has retraced to that point. All right. It retraced to that point. Sorry. So that's your OB. Can you see? Price came into that OB and reacted off of it, as you can see. The same thing happened here. All right. The same thing happened here. There is an OB sitting here. All right. You can go back and check on your own. There is an OB that you find here that is sitting somewhere here. All right. And that is where price reacted off from. Okay. That's where price reacted off from, because it got to the 50% FIP level. All right. Let me show you one more example. Now, price has violated this structure to the downside. All right. Now, as you can see, this retracement, is it a valid retracement? Yes. Okay. But wait, where is your high? This is your high. This is your last high. All right. And where is your low? Your low has now moved to this point here, guys. Isn't it? Now, this is your high. This is your low. Where is your retracement? Is it up to 50% FIP level? Let's see, guys. Let's see. Let's mark it and see. Oh, sorry, guys. Sorry. Internet. Okay, so let's see. Did it get to the 50% FIP level? Yes. As you can see, it retraced even more than the 50% FIP level. And that's why it's reacting off of this OB here. There is an OB here. If you go back and check, you will find it there. There is an OB somewhere here, sitting here. Price must get to that 50% FIP level. All right, at least. Okay, so this is the way you track your market. All right, this is a simple way for you to track your market. Now, in our next class, like I said, we are going to look at external and internal range liquidity, which will open your eyes wider for you to know what is happening in the market. The market does not just move randomly. The market moves on purpose. All right? I hope you enjoyed this video. Now, if you enjoyed this video, please don't forget to give us a like, and please subscribe and hit the notification bell, so that anytime we come out with a new video, I've told you, every week we'll be dropping an educational video about smart money concept. All right. And we are going to do that for quite some time to come, to teach you the real concept of how the institutions trade. Okay. All we require is for you to stick with us here. All right. Now, please share this video with your friends and family members if you enjoyed it. And don't forget, join our free Telegram channel. All right. I will leave the link in the description. We also have a Discord server. If you want to interact with other traders, please join our Discord server. I will also leave that link too in the description below. All right, guys. I hope you enjoy what we have offered you today. I see you next week. Have a wonderful week.